Hello, what's up, guys? Good afternoon, good morning, good evening, good whatever the time this is getting to you. My name is Trader. I'm a forex trader, and I trade currency pair mostly. Currency pairs. This is British pounds card, 15 minutes time frame. So this is my first YouTube video. My first YouTube video on my YouTube channel. The YouTube channel is fresh. I've never done one before, and that is because I really don't like to get popular with some stuff. But I think I'm happy doing this. I'm very excited to have you guys here watching my channel, and I hope you guys are going to find this very insightful, very educative. So this is a live trade which I caught just now. I just finished this trade. In fact, it was so painful because I had a session which I recorded this video at first, but I didn't know I stopped recording. I didn't even notice. And then the trade was even retracing. It was around here. So I wanted to make this video and to let you guys know this is the trade I caught. And that in that video that I recorded, which I thought I was recording, I already smashed the TP live. So but it happened. So it happens and no problem. So, like I said earlier, my name is Trader. Um, I'm the CEO, or let me say, I'm the founder of AMFX Academy. So, I trade smart money concept. A little introduction about myself. I've been trading for over 2 years. Yes, 2 years in the game. Taking it serious. Let's say 2 years. So, I trade smart money concepts, and I know a lot of guys in the forex trading space already are familiar with what smart money concept is, and I can just explain a little briefly about what smart money concept is. Let's use that to do our first video on this YouTube channel. I'm really happy once again to have you guys here, and I hope that we make good friends together. Yes, we make good friends together. So, what is smart money concept? SMC. This is just very simple. We understand this concept that it is a fact that the big banks, the big boys, the institutions, hedge funds, and the likes, those who have huge amount of money to trade the forex market, they are the ones that are responsible for the big movements in the forex market. So, and their traces are very significant when you look at the charts. It is very easy for you to get to know that they are in the market. So, when they get involved in the market, that is when you are going to see big moves like this, big moves like this, big moves like this, big moves like this as well. So they are not present in the market when you see choppy moves like this. Yes, when you see choppy moves, they are not present in the market. So oh, sorry. Yeah, so they are actually not present in the market when you see choppy moves. So then, how do we trade smart money concept? We only look at the charts. We look at places on the chart when it is visible that the big boys just loaded their orders. They just move the market to the downside, something like this. And we wait for this kind of retracement back to the point where they move the market, and we join them and we just ride the market together. That is how smart money concept trading is. So, but before you can be able to trade smart money concept, what are the things you need to know? There are these four key points. Number one is supply and demand. The concept of supply and demand is very crucial when you want to trade the smart money concepts. Also, fair value gap, which is what we call imbalance as well, inefficiency in the market. And number three is market structure shift, which is breaking new highs or breaking new lows or taking out new highs or even changing a trend entirely. So that's what we call market structure shift. And also the last one is the concept of liquidity. So these four concepts, these four things are the things that you need to know. When you are familiar with them, when you train your eyes to see them, you'll be able to trade the smart money concept profitably. I don't just trade smart money concepts, I also trade retail concepts like supply and demand, Fibonacci levels, support and resistance, trend line, moving averages, and the likes. So, but I mainly do that on the higher time frame when I want to get my buyers. So that is when I use those. But when I get to the when I drop down to the 15 minutes time frame, 5 minutes time frame, maximum 1 hour time frame, I use my money concept to get my entry and my exit. And the reason behind that is it gives me a very minimal risk when I'm getting into a trade, and I get high reward. Yes, I risk less to get more. Like take for instance, this on this trade, I was only risking 9 pips. You can see it right here. 9 pips, 9.8. Let's just say 10 pips. And I'm willing to get 32.3 pips, which is actually 3.3 times of my risk. This is 3% for God's sake if I'm risking 1% on my account. So it is very easy using this kind of trading strategy to pass whatever challenge you want to pass, because when you get familiar with this and you are being given something like maybe 8% or 10% to pass phase one, you know you should only need something like times three of this in order for you, 3 times of this in order for you to pass your challenge. So you need to get familiar with these 4 things: this supply and demand, fair value gap, market structure, and liquidity, for you to be able to trade this concept. So let me just go briefly on what these 4 mini concepts are before I stop this video. I say this is my first video and I'm really excited doing this. So I'm very happy. So let me just get us some insightful um, explanations. So what is supply and demand? One thing about life entirely when it comes to business is, for every buyer there must be a seller. So for you to be willing to buy something, there must be somebody who is willing to sell it to you. So this also applies in the forex market. For market to move bearish in this kind of bearish with this kind of bearish momentum, something like this or something like this, which means sellers are stepped in and they are really willing to sell the market explosively. But before they will be able to sell the market the kind of way they want to do, they need buyers. They need people who are going to buy what they want to sell. That is it. So for the big boys who move the market, we know they are the ones responsible for these big moves, these kind of moves that we are seeing. So who is going to buy what they are willing to sell? We all know that if the big boys want to buy and you are willing to sell to them, you are going to run loss, because the market will respect their own order, moving in the kind of direction they want. So either you are clicking on buy while they are trying to sell, you're just going to hit stop loss. It's as simple as that. You can't move the market. They are the ones moving it. But they need you to sell to them for them to buy. Or they need you to buy what they want to sell. So we know that we can't profit if we are going against them. That is, if you are selling to them for them to buy. So how do they now get their orders filled for them to make money? They simply take our stop losses. It is very simple. Because for every buy order that you place, your stop loss is automatically a sell order. So if they are willing to buy and your stop loss, if they are willing to buy and your stop loss is a sell order, they will first take your stop loss in order to execute their own buy order, which means you've sold to them using that your stop loss for them to buy. It is as simple as that. So where can we see that they bought the market? Where can we see where can we see they bought the market to take stop losses of previous sellers in order to sell the market? It is actually here. They actually injected buy orders to this upside to take some stop losses before they move down. How did we know? Let's just check out on something. This is Asia session range. You see this box right here, this pink box. This is the trading activities that occurred during the Asia session. So what is the trend of the Asia session? This is how to get a kind of bias that I'm trying to teach you. What is the trend in the Asia session? The trend is sell. So it means that traders in the Asia session are selling. And for these traders that are selling, for instance, maybe they saw this kind of bearish engulfing, something like this. See, this bearish engulfing, something like this. Yes, this is their session. So the first bearish engulfing they saw is this one. So maybe they came into the market, this bearish engulfing, their stop loss is going to be where? Above this bearish engulfing candle. And they will be willing to take their profit somewhere around this low. But then what happened after their session ended? The big boys came in, look at their stop losses right above this place, bought the market in order to punch this stop losses. And after taking these stop losses, this stop losses is automatically a buy order. It's automatically buy orders. So they took those buy orders. It means that they've gotten people to buy what they are willing to sell. So and these buy orders get their own sell orders get filled after taking these buy orders. So when it immediately got filled, the market started respecting them and the market started dropping to the downside. But the truth is, the amount of buy orders that they got from this area is not really enough for them to sell their market, but at least they sold some big portions of the orders that got filled, their orders that got filled. But how did we know? Just look at this. This area now becomes supply area because supply means sell while demand means buy. So which is the first concept, many concept on this. So this area becomes their own supply area. This is where they loaded their sell orders, and at the end of this 15 minutes candle, the next 15 minutes candle that started selling off to the downside. So it means that we get a supply area right here. This is their supply area where they loaded their sell orders before they started moving to the downside. So having that supply area in mind, what is the next thing? Fair value gap. The next thing on this list is fair value gap. Fair value gap means imbalances. That is, take for instance, look at this place from here to here. We have this place where candle is just standing alone without having any wick, something like this, filling the sides. So it means that the market is inefficient, is imbalanced. We just have series of sell, 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 sell candles without having a buy candle which is going to fill these imbalances. So I know majority of us already know what imbalances are. Yes, which is inefficient in market. When you have something like this, from this place, from this place to this place, it's just a three candle formation stuff. A three candle formation something. This 1, 2, 3. It's also right here. It's also visible right here. Look at this. This place from there to here. So looking at this, you see this wick stopped here while this candle formed. The next candle started, wicked up a little bit, then continue its movement to the downside. But this candle becomes inefficient because this from here to here, we only have sell orders. We don't have buy orders to fill these sell orders. So, but market has to be efficient before it continues its movement, either immediately or later in the future. It just has to be efficient. So traders who trade smart money concepts, we just wait. We are just going to wait for this travel back of price in order to fill up these inefficiencies and to tap into this supply area where they have some leftover sell orders. Remember I said earlier that these stop losses that rest above here are not enough. It's not enough for them to fill their sell orders. So there are still leftover sell orders right here in this supply area. There are still leftover sell orders. So the mitigation of this area will cause the market to continue its sell to the downside. So that is what you as a smart money trader is going to capitalize on. You don't have to rush. You don't have to try to catch a falling knife because if you try to catch this move, it can hurt you with this retracement. You're just going to hit stop loss and waste your money. So the best thing is for you to wait for this retracement back to the upside, take the remaining leftover orders here and ride the market together with the big boys to the downside, whereby making money together with them instead of them using you as liquidity. We're going to get to liquidity in a jiffy. But the third one right now is market structure shift. What is market structure shift? It's just very simple. Look at this diagram I put up here. This diagram. This is an example of a bullish market, and this is also an example of a bearish market. So anytime you have this kind of break of the previous high, the market has been moving point, from this point to this point, retraced a little bit back here, which is what we call pullback, then continue its bullish movement, whereby taking out the previous high in order to form a new high. retrace also back to this point, then continue its bullish movement, taking out this previous high already also in order to form a new high. So the act of taking out a previous high is what we call a shift, because on the lower time frame we are going to be having an opposite trend while trying to make a pullback. I don't know if you get what I'm trying to say. This is a bullish trend, but while making a pullback, we are going to be having something like this. Let me change this to sorry, how am I going to do this? Opacity. Sorry. Okay, I'll do that later. So don't let me just use this to yeah, to take our time. So what I actually wanted to do is make this a very thinner line, but let me use this instead. So um, let me use this part two. So assuming this the bigger picture, which is the coming. Let me draw this first. Let me finish up with this first. Okay, okay. So the bigger picture, which is this one. Let's say this is an higher time frame picture, which is, let me say, 1 hour time frame. But you see, in this bigger picture, we have a smaller time frame trend, which is maybe the 5 minutes or 15 minutes trend. So the movement of this smaller time frame trend shifting. Let me make this more clearer. Sorry guys, this is my first video. This happens sometimes. Okay, I think this is clear. This is a little bit clearer. Yes. So we have trend in trend, which is smaller time frame trend. In a bigger time frame, in a 1 hour time frame trend, we have like 5 minutes time frame trend. So when having a pullback in a 1 hour time frame trend, when having a 5 minute when having a pullback, we are going to have a 5 minute bearish structure, which is sell. You get? Yes. But when resuming the impulsive 1 hour time frame buy trend, bullish trend, we are going to be having a 5 minute bullish trend. So shifting from bearish to bullish in order to continue the dominant trend is what we call market structure shift. And we have two types of market structure shift. We have break of structure, which is just a trend continuation, something like this. Break of the previous high or previous low is what we call break of structure. Yes. So we also have change of character. What do I mean by a change of character? Dominantly, we are having bullish structure, but now trend wants to change. So when a trend changes, what we call change of character, and we are going to get something like this. Yes. So instead of having a lower high just to continue a higher high, instead we have a market structure shift or a change in structure. Instead of that, we are going to be getting a change of character. So that is what we call change of character. So these are the two types of market structure shift that we have. We have a change of character and we have a break of structure. Change of character is mainly used for reversal, while break of structure is used in confirmation of continuation of trend. I hope you guys get it. So this same explanation in a bullish environment is also what we are going to use for a bearish environment. So let me just don't use that to take our time anymore. So and the last one is liquidity. So what is liquidity? What do we call liquidity? It is very, very simple. Liquidity is money. Money that is being injected into the market for the market to move, for the market to, to sail like a boat, on the sea. So that's what we call liquidity. So one type of liquidity is all these stop orders, which is the kind of stop hunt that I explained earlier. Taking stop losses above here is liquidity. They use this money that are resting above here in order to fill their order to sell the market. So liquidity is everywhere in the market. Whenever you see any high or low or session high or session low or whatever it is, there's liquidity resting above it. Yes, exactly. There's liquidity resting above it. So liquidity is what moves the market. Yes, liquidity is what moves the market. So that is what I don't want to make this video too long. I know in subsequent videos I'm going to be explaining deeper on what liquidity is, concept of liquidity, the type of liquidity we have, and how liquidity moves the market, how it actually really works. Yes. So I used this concept. Sorry, I think I'm having network downtime or something. So I use this concept in order to catch this trade. So how did I do that? So this is a low which was spotted. We are in a bullish. Sorry. I'm having. Sorry, guys. Sorry, guys. I'm very sorry. I had a bad network down. I had a network downtime. So I actually want to explain how I caught this trade using these four trading concepts under the smart money concept. So the first one is supply and demand. So I got this supply zone when I knew that this stop losses here has been raided and their orders are being loaded at this place, and I saw this kind of move. So I got this supply zone. So I got that supply zone. So I got this supply zone knowing fully well that stop losses has been raided, yeah, liquidity has been taken, and their orders has been executed, has been filled. So that is number one. And number two is there's a presence of fair value gap. It means that I spotted inefficiency in the movement, so which price is eventually going to come to fill up before it continue its bearish movement, which is number two, fair value gap. Also, what is number three? Market structure shift. I noticed this low being taken out by this move, which is very massive. So it confirmed my trade that this is going to be a sell continuation trade. And number three, I noticed the liquidity that I said earlier that money has been taken here and the smart money, the big boys are present in this move. So I also want to join them, but I'm not trying to catch a falling life. So I just waited for this pull back into this supply zone, and from this supply area I joined and I was able to smash TP. So this is how I use market structure shifts, fair value gaps, supply and demand, and liquidity, which is the smart money concept, in order to trade the forex market. So I'm really excited and I'm very, very happy to have you guys here once again. And I hope you guys find value in this YouTube video, which is my first YouTube video on this channel. I'm very, very excited. I was able to do this. So if you find value, if you enjoy this and you want more knowledge impacting videos like this, please do well to subscribe, like, and comment in the comment section. Ask questions. You can even tell me what you want me to do next in the video, so which is going to help you. Drop them in the comment section. I promise to check them and also get back to you guys. Thank you very much for having you once again. Please subscribe to my channel. It's going to help me a lot. It's going to help me get going in doing this video, and it's going to help you as well because we're going to learn a lot from me. Thank you very much once again. This is AM Trader signing out.